considering lifetime transfers as part of your inheritance tax planning strategy, you will always, of course, have in mind and tell your clients to have in mind that great idea to make lifetime gifts if you can. Think about CGT if you're going to make a disposal of a chargeable asset, all that sort of stuff. Think about the liability to tax that might arise if when the transfer is made, if the transfer is a chargeable transfer, i.e. other than an outright gift or a gift into a bare trust. Otherwise, there should be no tax payable when you make it. And of course, even if it is a chargeable transfer, there'll be no tax payable as long as it's within the available nil rate band. So, all good. Next thing to consider is if you die within 7 years of making the transfer, then as well as that transfer eating up some of the nil rate band that will be available to your estate on death, the transfer may give rise to a liability to tax itself. Right, how does that happen? Well, at that point, when the transfer was made, if you die within 7 years of making it, when the transfer was made, if it exceeded the nil rate band available to it, taking account of transfers made in the 7 years preceding that, so that's chargeable transfers or failed pets made within the 7 years preceding that transfer, then a liability to tax could arise. So if a liability to tax could arise with the nil rate band having been exceeded, then how do you calculate that? Well, you use the rate of tax applicable on death, the 40% rate, and apply that to the excess over the nil rate band applicable to that lifetime transfer, which has become chargeable as a failed pet or has to be reassessed if it's a chargeable lifetime transfer to see if a liability arises. Okay, if no liability arose when it was made on a chargeable lifetime transfer, then there won't be a further liability on death, because at that point it will have fell within the nil rate band, presumably. I suppose the only thing that could have occurred, that there could have been a potentially exempt transfer that was made before the chargeable lifetime transfer, which has now failed if you died within 7 years of making it, which could mean that a chargeable lifetime transfer that was not subject to tax when it was made is now subject to tax when you do the recalculation because you died within 7 years of death. So whatever the liability is on the failed pet or the chargeable lifetime transfer then has to be paid on death, separate, in addition to any tax that's payable on death. Then it's important to remember, does taper relief come to your aid? Well, it can and will if you died more than 3 years after making the transfer. If you die within 3 years, there's no of making the transfer. We're talking calendar years here, from the date, well, not calendar years, years from the date of the gift being made. So if you survive the gift by more than 3 years, then taper relief applies. Taper relief doesn't reduce the value of the gift, it reduces the tax on the gift. So if there is no tax on the gift, because it fell within the nil rate band, leaving aside exemptions, then you don't need taper relief. You don't taper the value of the gift and therefore give yourself more nil rate band available to the estate on death. It's only tapering any tax liability that arises. So how does this taper work? Well, you don't get it if you die within 3 years of making the transfer, and that gives rise to a liability to tax. However, you do get it if you die more than 3 years after the gift has been made. So how much is that taper relief? How does it work? You basically apply a percentage, a reduction effectively, to the full rate of tax, the 40% rate of tax. So basically, if you die between 3 and 4 years after making the transfer, then you only apply a tax rate equivalent to 80% of the full death rate. So that's 40%, the full death rate. So 80% of 40, you'd apply a 32% rate to it. If you die between years 4 and 5, so you survive 4 years but not 5 years after the gift, then you apply 60% of the death rate, and that means you'll pay an effective rate of 24%. If you survive 5 years but not 6, so between 5 and 6 years is when, after the gift, is when you die, then you apply the 40% reduction, which means that you have an effective 16% rate. And if you die between years 6 and 7, then you have a 20% of the main rate applicable. So that means 8%, 20% of 40%. If you survive 7 years, then you ignore the transfer altogether, has no liability of itself, and it doesn't eat up the nil rate band on death. So taper relief applies to reduce the rate of tax. It doesn't apply to reduce the gift. It's also important to remember that should you have made a chargeable lifetime transfer and you've already paid a 20% liability on it, and you die more than 5 years after having made the gift, then you've got, the effective rate of tax that's applicable for that period is 16%. And that's lower than the 20% I've already paid. I'll have some money back. Unfortunately, you can't. So there's no money back if you die. And if you'd made a chargeable lifetime transfer and paid 20%, but then died more than 5 years after making the gift, between years 5 and 7, then there's no way you can get the 20% back. I mean, if you survived 7 years as well, there's no way to get the money back. All of this is described much more clearly and in more detail in Technic.